He was the sitting town mayor, a graduate of two of the most prestigious schools in the Philippines. And for years, he ran what investigators would later call one of the largest financial frauds in Philippine history. From inside his own hospital room, Celso de Los Angeles built an empire of banks and insurance plans that reached millions of ordinary Filipino families. The kind of plans parents bought to pay for their children's college tuition or their own funerals. When it all collapsed, it left behind a 30 billion peso hole, 12 closed banks, and victims who are still waiting to be paid back more than a decade later. And in the end, the man responsible never spent a single day in an actual prison cell. This is the story of the Legacy Group. Celso de Los Angeles wasn't some street-level con artist. He came from a well-connected family. His great-grandfather had been the mayor of Marikina City and was credited with founding the city's famous shoe industry. De Los Angeles himself held a business degree from the Ateneo de Manila University and a master's degree from the Asian Institute of Management, two of the most respected schools in the country. He'd worked in the United States for nearly a decade before returning to the Philippines in 1997. By the time his empire began to unravel, he was also the sitting mayor of Santo Domingo in Albay province, a public official, not a fugitive hiding in the shadows. Starting in the early 2000s, de Los Angeles built something that looked, on paper, like an impressively diversified financial empire. A network of 13 rural banks across the country, alongside legacy consolidated plans. A pre-need company. Pre-need plans are a uniquely important financial product in the Philippines. Families buy them years in advance to lock in the cost of major life expenses, a child's college education, or a parent's eventual funeral. That makes pre-need plans different from a typical risky investment. These weren't speculators chasing high returns. These were parents trying to responsibly plan for their children's future, and the Filipinos trying to spare their own families the financial burden of their own funeral. Legacy Consolidated Plans and its network of rural banks reached millions of clients across the country. Small depositors in rural provinces who trusted local banks precisely because they felt safer, smaller, and more community-rooted than Manila's giant institutions. Investigators would later allege that very little of that trust was deserved. According to the Bangko Sentral ng Pilipinas, de Los Angeles and his network of bank officers created fictitious loans. Loans that were never actually requested by any real borrower, and then quietly funneled that money for personal gain. In one case alone, central bank investigators said de Los Angeles and an associate misappropriated nearly 4 billion pesos from a single bank, the Bank of East Asia, entirely through fictitious loans that didn't correspond to any real borrower at all. It wasn't one scheme. It was dozens, spread quietly across 13 different rural banks, each one small enough on its own to avoid serious scrutiny, until regulators started connecting the dots. By December 2008, the central bank had seen enough. The Bangko Sentral ng Pilipinas ordered the closure of de Los Angeles's rural banks, citing what it called unsafe and unsound banking practices. 12 banks, holding over 14 billion pesos in insured deposits across more than 130,000 individual bank accounts, were placed under receivership. For tens of thousands of ordinary Filipino families, the money they'd saved for their children's education or set aside for their own funeral was suddenly frozen, tied up in an unraveling scandal they'd had no way of seeing coming. As regulators dug deeper, The charges piled up fast. In January 2009, the central bank filed 49 counts of falsifying public documents against 16 legacy bank officers and employees. By February, the Securities and Exchange Commission filed criminal charges against De Los Angeles directly for selling unregistered securities to hundreds of unsuspecting investors. Then, on February 26th, the central bank filed its first estafa, or large-scale fraud, and case against De Los Angeles personally, accusing him of orchestrating the swindling of public depositors. It was just the beginning. Over the following 2 years, prosecutors would file case after case, each one tracing money from a different bank, a different province, a different group of victims, eventually totaling well over 5 billion pesos in formally documented estafa charges against him alone. Throughout the investigation, De Los Angeles never stopped defending himself publicly, and he never stopped pointing fingers elsewhere. He accused central bank investigators of coercing his own employees in Cebu into producing false evidence against him. He claimed his downfall was the result of unfair media coverage, regulatory interference, and even extortion attempts by government officials. One whistleblower inside the case went further, alleging in a sworn statement that De Los Angeles was protected by an extensive network reaching into the central bank, the SEC, the deposit insurer, Congress, the judiciary, and even the National Bureau of Investigation itself. Whether that full network was real or not, one thing was undeniable. De Los Angeles had genuine political connections. He had previously served as a director and even president of a national housing finance corporation. He'd been linked to a vice president's election campaign, and years earlier, during a separate corruption scandal involving a disgraced former president, his name had surfaced as an alleged collector for an illegal gambling operation. This was not a man operating on the margins of power. He was embedded inside it. Then, just as the case against him was building real momentum, the story took a turn that frustrated investigators and victims alike. De Los Angeles announced he had been diagnosed with throat cancer. He was admitted to St. Luke's Medical Center in Quezon City. And when a warrant of arrest was finally issued in July 2010, he was served the warrant while confined in his hospital bed. He remained under what's called hospital arrest, continuing chemotherapy treatment, even as multiple courts across the country attempted to actually take him into custody to face trial. In August 2010, he was briefly transferred out of the hospital to a police station, then to a jail facility in Ormoc City to face charges there. But within a day, his lawyers successfully petitioned to have him moved back to a hospital, citing his deteriorating health. For the next year and a half, De Los Angeles would shift between hospitals in Ormoc, Tacloban, and Quezon City, facing cases in courts across multiple provinces, almost never appearing in any of them in person, his lawyers consistently arguing he was too ill to travel. On March 27, 2012, Celso de Los Angeles died at St. Luke's Medical Center. He had spent the final years of his life on hospital arrest, never convicted, never having served a single day in an actual prison. Under Philippine law, his death legally extinguished his criminal liability. Every case against him personally was dismissed, not because he was found innocent, but because there was no longer anyone left to prosecute. He was the second person connected to the legacy scandal to die before facing real consequences. An SEC commissioner who had reportedly accepted a house and a luxury car as gifts from the legacy group had died years earlier, in 2009. The other executives and bank officers named alongside him in dozens of estafa cases still face prosecution. But the man at the very center of the 30 billion peso collapse was gone. And so, legally, was the case against him. More than a decade later, the Philippine Deposit Insurance Corporation has paid out billions of pesos to depositors of the failed legacy banks. But by the agency's own accounting, that has only ever covered a portion of what was actually lost. Legacy wasn't a scheme that targeted reckless gamblers chasing impossible returns. It targeted families doing the responsible thing, saving early, planning ahead, trusting a system that was supposed to protect them. And the man who built it spent his final years not in a courtroom, but in a hospital bed, until the case against him simply ceased to exist. Sometimes the most dangerous fraud isn't the one promising you'll get rich. It's the one wearing the careful, responsible disguise of saving for your family's future. If you enjoyed this story, consider subscribing for more stories like this.